Everyone knows the Luckin Coffee story. Chinese startup fakes $310 million in sales. Gets caught. Gets delisted. The end. Except that's not how the story ends. Because the company that fabricated 40% of its revenue is now the largest coffee chain in China, 31,000 stores. More than Starbucks, with 98 million customers a month. The stock is up over 2,000% from the crash. And the CEO just announced plans to return to Nasdaq, the same exchange that expelled them 5 years ago. So either the fraud destroyed Luckin Coffee, or it didn't. And if it didn't, if a company can fake its way to the top and then become legitimately successful, that raises a question the financial world would prefer not to answer. Charles Zhengyao Lu didn't stumble into coffee. He engineered empires. By the time he founded Luckin in October 2017, he'd already built CAR Incorporated into the largest car rental company in China. His playbook was simple. Raise enormous sums of money, spend faster than anyone else, and suffocate the competition before it can react. His protégé, Jenny Qianjia, had been his chief operating officer at CAR Incorporated. She understood the formula. Together, they opened Luckin's first stores in January 2018. Tiny pickup kiosks in Beijing and Shanghai. No seating, no ambience, just an app and a counter. Luckin was never meant to be a coffee company. It was a blitz-scaling machine. Coffee was simply the fuel. The growth was staggering. In 12 months, Luckin opened 2,000 stores. By month 18, 4,500. Each one was the same. A counter the size of a closet, an espresso machine, and an app that offered coffee at half the price of Starbucks. No tablets. No Wi-Fi lounge. Just speed. In July 2018, Luckin raised $200 million in its Series A. The pitch was irresistible. China had 1/40th the coffee consumption of the United States. The market was a vacuum, and Luckin was filling it faster than anyone thought possible, subsidizing every single cup below cost to build a digital army of caffeine-dependent customers. For 1,500 stores in 18 months. Starbucks had taken 20 years to reach that number in China. On May 17, 2019, Jenny Qianjia rang the opening bell on Nasdaq. Luckin Coffee had gone from its first store to a public company in 18 months, the fastest founding to IPO in American stock exchange history. Shares hit $25.96 on day one. Harvard Business School wrote it up as a case study in disruptive growth. The narrative was intoxicating. China's Starbucks killer, armed with artificial intelligence and the most aggressive expansion in retail history. In January 2020, riding the euphoria, Luckin raised another $821 million through a share placement and convertible bonds. Investors poured nearly $1 billion into the company in a single month. 3 months later, they would discover that almost half of what they'd invested in was fiction. The fraud was remarkably simple. At stores across China, employees scanned fake coupons at empty counters. Each phantom transaction averaged about 25 renminbi, roughly $3.50. A single fake order was invisible, but multiplied across thousands of stores, day after day, the fiction added up to $310 million in fabricated revenue for 2019 alone. The scheme was orchestrated by Chief Operating Officer Jian Liu, and it started as early as April 2019, just weeks before the IPO roadshow. While investment bankers in New York were pitching Luckin as the future of Chinese retail, employees in Shenzhen were scanning barcodes for coffee that didn't exist. Every growth chart the investors studied, every revenue figure they modeled, 40% of it was air. On January 31, 2020, a man named Carson Block published a link on Twitter. It led to an anonymous 89-page investigative report. The authors had hired people to sit outside Luckin Coffee stores across China, recording everything. 11,200 hours of video footage. They counted customers walking in. They counted cups walking out. The numbers didn't match. Items sold per store were inflated by at least 69% in the third quarter of 2019. By the fourth quarter, the inflation reached 88%. Block's firm, Muddy Waters Research, had built its reputation on exposing fraud in Chinese companies listed on American exchanges. On February 3rd, Luckin issued a formal denial. The company called the report misleading and accused short sellers of market manipulation. The denial was firm, confident, total. It lasted exactly 58 days. April 2nd, 2020. Luckin Coffee issues a statement that lands like a detonation. An internal investigation has confirmed the allegations. Chief Operating Officer Jian Lu fabricated approximately 2.2 billion renminbi, $310 million, in 2019 sales. The denial had been a lie about a lie. Markets react instantly. The stock crashes more than 80% in a single trading session, wiping out billions in shareholder value. On April 8th, American exchanges halt all trading on Luckin shares. The fastest IPO in history is now on life support. In Beijing, employees arrive at headquarters to find reporters camped outside. In New York, class action lawyers begin filing suits before the markets close. The Harvard case study, the one celebrating Luckin's genius, quietly disappears from the syllabus. The dismantling was surgical. May 15th, Nasdaq issues a formal delisting notice. The same week, Goldman Sachs seizes Charles Lu's personal stock holdings after he defaults on a $518 million margin loan. The man who built the machine can't cover his debts. CEO Jenny Chen-Jia is fired. CEO Jian Lu is fired. On June 29, 2020, Luckin Coffee is officially delisted from the Nasdaq 13 months after its IPO. The fastest listing in American exchange history becomes one of the fastest exits. Shares migrate to the over-the-counter pink sheets, trading at a fraction of their peak. 4,500 stores still stand across China. The coffee machines still work. The app still functions. But nobody is running the company, and nobody expects it to survive. The penalties arrived in waves. December 2020. The SEC settlement, $180 million. Luckin paid it without admitting or denying wrongdoing. Then came the class action settlements, $187.5 million to shareholders who'd watched their investments evaporate. Chinese regulators added another $9 million in fines. Total cost of the fraud, more than $376 million. A board investigation concluded that Chairman Charles Lu knew or should have known about the fabricated transactions. He was ousted. The shares, once worth over $50, now traded on over-the-counter pink sheets for pennies. This is where every other documentary about Luckin Coffee ends. The rise, the fraud, the fall. Story over. But there is a second act that almost nobody talks about, and it is more extraordinary than the first. In 2021, a Chinese private equity firm called Centurium Capital did something that baffled the financial press. They injected $240 million into Luckin Coffee, the most toxic brand in Chinese corporate history. They installed a new CEO, Guojini, a quiet operator who had been at the company since its founding but had no connection to the fraud. They brought in Reinout Skakel, a former Morgan Stanley banker, as chief financial officer, and they restructured $460 million in debt by December 2021. The fraudsters were purged. The governance was rebuilt from scratch. But the critical question remained. Strip away the fake numbers, strip away the inflated growth charts, strip away the phantom customers. Was there an actual business underneath? The answer stunned everyone. Underneath the fabricated numbers, Luckin's business model was genuinely viable. The tiny pickup kiosks, no seating, no elaborate interiors, just an app and a counter, had absurdly low overhead. The app-first ordering system eliminated labor waste. And here was the number that mattered most. 60% of Luckin's reported sales had been real. Millions of Chinese consumers had genuinely developed a coffee habit through Luckin's subsidized cups. When the fraud was stripped away, the customer base remained. Same-store sales stabilized. Then they started growing again. Legitimately, The brand that should have been radioactive turned out to be resilient because the product, cheap, fast, app-delivered coffee, actually worked. The fraud had been unnecessary. The business never needed it. By the end of 2025, the numbers told a story that defied every prediction. 31,048 stores. Luckin had opened 8,708 new locations in a single year, roughly 24 new stores every single day. Fourth quarter revenue reached 12.8 billion renminbi, up nearly 33% year over year. 98.4 million people used the Luckin app every month. The stock, trading on OTC markets, had surged 2,354% from its 2020 low. And here was the fact that silenced the skeptics. Luckin now operated more stores in China than Starbucks. The company that had faked 40% of its sales was now, by every legitimate metric, the largest coffee chain in the most populous country on earth. The fraud had been real, but so, it turned out, was the empire. In November 2025, CEO Guojini stepped onto a stage at the Xiamen Entrepreneurs Day conference and made an announcement that sent shockwaves through financial markets. Luckin Coffee was preparing to relist its shares on a major American stock exchange. The company was going back to Wall Street, potentially to the very Nasdaq that had expelled it 5 years earlier. The stock surged 50% on the news. And Luckin wasn't just returning to American capital markets. It was entering American streets. 5 stores had already opened in New York City, selling coffee at 52% below Starbucks prices. The company born from a fraud in Beijing was now setting up shop in Starbucks' own backyard. And this is where the story gets uncomfortable. Because there is a question that nobody in the financial press seems willing to answer directly. Did the fraud help? Luckin burned billions of investor dollars building brand recognition, app downloads, and daily coffee habits across China. 40% of the sales were fake, but 60% were real. 380 million cumulative customers got hooked on cheap coffee through subsidized cups paid for by defrauded investors. When the fraud was exposed and the fake numbers disappeared, those real customers remained. The infrastructure remained. The brand recognition remained. Harvard pulled the case study. But the case itself, a company that cheated its way to dominance and then became legitimately dominant, is more instructive than anything a business school could teach. In Silicon Valley, they call it fake it till you make it. Luckin Coffee took that philosophy to its logical extreme. Fabricated $310 million in revenue, got caught, paid $376 million in penalties, lost its founders, lost its stock exchange listing, and then actually made it. The fines were real. The prison investigations were real. $1 billion of investor money was torched in the process. But the company survived. Thrived. It grew larger than the competitor it was originally pretending to beat. And now it wants back on the exchange. The question this story poses isn't about coffee. It's about systems. If fraud can serve as a launchpad, if cheating works eventually, what does that say about the market that's supposed to prevent it? $310 million in fake sales. A 97% stock collapse. Delisted. Disgraced. And 5 years later, 31,000 stores, more than Starbucks, and a return ticket to Wall Street. Every cup of Luckin Coffee sold today is real. The revenue is audited. The customers are genuine. But the empire was built on a foundation of fiction. And that's the thing about Luckin Coffee. The cup was always full. It just took 5 years to find out what was actually inside it. If this story changed how you think about corporate fraud or survival or the strange machinery of modern capitalism, subscribe. Because the stories that end where you expect them to are never the ones worth telling.